How's it going, everybody? My name is Jack, and I'm going to be talking about private debt instruments. So just to give a brief overview of private debt, it is debt investments made by private investors. These investments include loans and the purchase of securities. These are common for small and medium-sized companies as well as distressed companies. The companies use these funds to make acquisitions or finance growth. Private debt investors include insurance companies, pension funds, foundations, endowments, and asset managers. There are a wide variety of private debt funds financing areas like real estate, infrastructure, and startups. Private debt investing is seen as a good way to diversify one's portfolio, and numerous forms have been known to return high yields. Currently, assets are valued at around $638 billion globally and are expected to grow to $2.5 trillion in the next 10 years. The first form of private debt I'm going to be talking about is direct lending. Direct lending takes the form of senior loans made to small to medium-sized companies. This is performed without an intermediary, such as an investment bank, broker, or private equity firm. Following the Great Recession, lending standards for banks increased. These smaller companies were no longer able to receive bank loans. This is where the private debt market comes in. Direct lending gives companies access to capital in order to finance growth. It gives the investors the opportunity for strong, predictable returns higher than that of corporate bonds. Direct lending can allocate capital to any industry where analysis shows the potential for solid, steady returns. Industries can range from telecom to healthcare to retail. There are numerous cautionary tales when it comes to direct lending, but with proper execution and diligent use of computer analytics, direct lending can achieve consistent and high returns. The market had $600 billion worth of assets in 2017 and is expected to hit $1 trillion this year. Next, I'm going to be talking about real estate debt. Real estate loans are made by private lenders directly to borrowers. The common form of real estate debt is through direct lending. Within direct lending, real estate is the most popular type of collateral. Private investors, such as private real estate funds, work with borrowers who are most often developers. The borrowers have complex financial situations or do not have access to conventional credit for whatever reason. Private real estate loans are sold on the secondary market as securities. After the Great Recession, the banks failed to provide debt liquidity, which enabled private lenders to emerge and fill the void left by the banks. Since then, private debt in real estate has been a growing market. Next, I will be talking about distressed debt. Distressed debt refers to the securities of a company which have defaulted, are under bankruptcy protection, or are in financial distress and moving towards these situations in the near future. A situation where a company experiences distress may be due to the market economy, industry-wide trends, or internal mismanagement. The most common distressed debt securities are bank debt, bonds, trade claims, and common and preferred shares. The purchaser of distressed debt becomes a major creditor of the distressed issuer by purchasing a large number of the issuer's securities. They then have the leverage to prescribe terms for reorganization. The purchaser of the securities believes price dislocation is present. If the reorganization is successful or the market improves, they get a positive return on investment. Should the company be liquidated, distressed debt firms may recover the entire amount invested because they are entitled to be repaid before equity holders. The nature of distressed debt makes it a high-risk, high-yield investment. Next, I will be talking about special situations. In special situations, the investor purchases securities of a company with a healthy core and that is often or could be profitable. But the company is in a situation of underperformance, balance sheet distress, untapped developmental potential, or fundamental transition. This is similar to distressed debt in that within the company there is a price dislocation present with the company's securities. These companies have a sound fundamental core but are either in a complex transition structures, including succession and carve-out situations, or in a situation of underperformance, balance sheet distress, or have liquidity problems. The interests of the investors are in taking control of stakes in the company. The investor is trying to control the company and create a turnaround. This is where it differs from normal distressed debt. With distressed debt, the investor does not necessarily take control of the company. In special situations, they do. Next, I will be talking about mezzanine debt. Mezzanine debt is subordinated debt with equity enhancements attached. With mezzanine debt, the lender receives a piece of the action in the company's business. they receive what is known as an equity kicker. Most of the time, this will be in form of warrants. Warrants are an equity instrument where the lender will receive the ability to purchase the stocks in the company at an agreed upon price over a fixed period of time. Subordinated loans are loans in which the lender gets paid back after the senior loans if the company goes bankrupt. The increased risk of these loans means that the interest rates are higher. With mezzanine loans, the company gets to take out the debt at a lower rate than a normal subordinated loan. For some companies, a mezzanine loan may be their only option when it comes to taking out a subordinate loan. The lender receives a benefit of the prospect of future growth in the company. If the company is successful, the lender will receive more compensation than with a normal subordinated loan. This type of loan is most often used in leveraged buyouts. The equity component makes it riskier than normal forms of lending. Following mezzanine debt, there is venture debt. Venture debt is a type of debt financing obtained by early-stage companies and startups. These companies have some history of operations but still do not have sufficient positive cash flows to be eligible to obtain conventional loans. Due to bank regulations, companies may not be able to receive loans from a bank due to their size. Venture debt does not require any form of collateral because startups generally do not own substantial assets that can be used as collateral. Instead of collateral, the lenders are compensated with the company's warrants. The primary benefit of venture debt for these companies is that it prevents further dilution of the equity stake of a company's existing investors. The debt is short to medium term in nature, and there is a high amount of risk associated with it, with a very high upside. The last form of private debt I will be talking about is infrastructure debt. Infrastructure includes assets such as transportation, regulated utilities, and renewable energies. Infrastructure assets are financed with both equity and debt, with debt being the predominant financing option at 75%. These assets and the organizations that run them are viewed as essential drivers of any economy. Due to the nature of the assets, their returns are often demand resistant and are less sensitive to the wider economy. Investors in infrastructure are attracted to the fact that the underlying assets generally generate robust revenue streams over long periods of time. Before the Great Recession, 90% of infrastructure debt finance was done by banks. After the recession, regulations imposed on the banks have allowed for more private investors to enter the market.
So now I'm going to be explaining public debt instruments. I'll start out by speaking about what exactly public debt is, the type of instruments that is used, the short-term debt, long-term debt, the instruments that are used for both of those, as well as the pros and cons of public debt instruments. So what exactly is public debt? Well, it has a bunch of different names, like national debt, federal debt, and sovereign debt. It is essentially government overdraft. The government pulls out more money than it brings in, and this is used to pay off capital projects over periods of time rather than just all at once. And a capital project is a permanent and essential structure or tool used to benefit a community. And some examples of capital projects would be buildings, roadways, bridges, public facilities like parks and public schools, as well as things like police cars and fire trucks. And so what the debt instruments are used for is to reduce this debt over time through investors. So there are three types of debt instruments, public debt instruments, and those are bonds, loans, and debentures. The point of these instruments is to raise capital and to generate investment income. A bond is an instrument where an issuer is indebted to holders. And so, for example, some examples of bonds that are used for public instruments are municipal bonds and treasury bonds. A loan is the lending of money to an individual or a corporation. In return, the recipient of the money is charged interest on the amount that they have received. And a debenture is similar to a loan, but it's mostly used for larger companies, and they pay back the borrowed money at a fixed interest rate. So there are two specific types of public debt that I'm going to be focusing on, and those are short-term debt and long-term debt. So short-term borrowing by governments can be used in the occurrence of local or national emergencies to increase cash flow. And this shouldn't be used all the time, especially for things like government operations. And these short-term instruments that are used are things like loans and leases. Now, long-term debt is separated into two forms. There's guaranteed debt and non-guaranteed debt. And both of these are broken down into two more parts. And so first, within guaranteed debt is general obligation bonds. And general obligation bonds are federally set debt securities. They are considered to be risk-free because they receive full faith and credit under the full faith and credit clause. The sales of these bonds finance the national debt. For revenue bonds, also known as municipal bonds, they are backed by specific streams of revenue. These are issued by several different government agencies to fund projects like school levies and infrastructure. In non-guaranteed debt form, term bonds have set maturity dates, so no matter what, they will mature at a set date. And serial bonds are a grouping of bonds that mature over regular intervals until all of the bonds have fully matured. Some pros about public debt instruments are, in the short run, governments issue bonds that are created for investors. This creates short surges of increased funding for economic growth. These instruments also make it safer than foreign direct investing, which is where foreign markets purchase 10 or more percent interest from countries, businesses, and real estate. And overall, the standard of life will improve within the country and within communities. Infrastructure will improve, and roads and bridges, schools will improve, and many other things that will help benefit the community. Some of the cons of public debt instruments are, in past years, the government has borrowed much more money than they have been able to receive back. This leads to critical debt levels, which will increase the interest rates due to the increased risk for investors. Public debt instruments make it harder for countries to refinance their debt. By refinancing, it allows a country to receive the best possible interest rate in order to pay it back. Over the long run, debt builds up and becomes harder to pay back. To conclude, public debt instruments have both good and bad effects on countries and communities. Leaders need to find middle ground where public debt is large enough to drive economic growth while maintaining interest rates.